The major US stock indices continues to trade in a very strong bullish footing despite earlier losses that's been seen at the start of the US session yesterday due to the fiasco between the US White House and the US Federal Reserve, where Fed Chair Powell is being issued with a potential criminal charge by the Department of Justice. And very interestingly, the Dow Jones Industrial Average, the S&P 500, and the Russell 2000 surged to fresh all-time high yesterday ahead of this week key US banks institution earnings results release. The US dollar on the average managed to trade weaker yesterday despite the fact that there's a one-way rising movement on the yen weakness against the US dollar. And also the yen weakness did not get negated despite the fact that the Japanese finance minister expressed concern about this rapid depreciation of the yen with her counterpart, which is the US Secretary, last night. Very good morning to all. Welcome back to today's Daily Dose of Market Insights. I'm Kelvin here. Today will be the Tuesday, the 13th of January 2026. So before we kickstart the gist of the Daily Dose, let's have a quick look at the disclaimer first. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right. Okay, very quickly, just now I forgot to flash the disclaimer slide. Okay, hopefully all is good on the screen. All right, I think it should be good, yeah. Okay, so yes, so before we kickstart the gist of the daily dose today, which is a much more of a slimmed down version where I will not be showing all the intraday technical outlook on all the broad-based cross asset classes. Instead, I will feature some very interesting technical configuration that has just been involved, being selected as charts of the day. So before we jump straight into the charts of the day, let's have a quick recap in terms of what has taken shape yesterday and in early Asia session. So we know that yesterday, the US stock market opened on a very weak footing, all right? So this opening of this weak footing is due to that ongoing fiasco between the US White House and as well as Trump insistence indirectly of removing the current Fed Chair Powell. So Fed Chair Powell was actually issued with the Department of Justice subpoenas, charging him for a criminal offense due to his management of the latest Federal Reserve headquarters overrun on its renovation cost over here. And Powell actually votes to actually stand firm and fight back. And he did issue a public statement, totally kind of a disagree with what the current White House administration is doing to him over here. And based on what has taken shape yesterday, within Trump's own GOP, which is the Republicans. So due to this current so-called latest, we call it very hardman approach of US President Trump of trying to use all sorts of ways to remove Fed Chair Powell, despite the fact that he will be stepping down as the Fed chairman in this coming May over here. So the reason why the current White House wanted to remove him, because given the fact that, let me share with you guys, so we know that yes, his chairmanship will end in May this year, which is a couple of months time. So, but over here, he still could remain at the Fed governor, and his term doesn't end until 2028. So by the time we hit 2028 over here, that will be the potential end of Trump's term as a US president as well. And we know that the Fed chair doesn't control interest rates solely. That means he can't dictate where the Fed funds rate will be. It will be the Fed got to have a consensus view or overall voting system that involves Fed governors and as well as the respective Fed president of the various district banks over here. So even the fact that Trump potentially could name the next Fed chair, which is likely to be a very dovish Fed that is aligned with the White House overall arcing policy of having a low interest rate. But the new Fed chair cannot say that, hey, I want a low interest rate in this FOMC meeting. But he need to have the consensus of the Fed governor and as well as the various Fed presidents of the various district banks. So if Powell continues to remain as a Fed governor until 2028, he could potentially sway the decision-making process of the Fed governors and as well as the Fed presidents, and thereby blocking that so-called dovish new Fed chairman of implementing the White House policy. All right, so with that, market choose to ignore this fiasco in terms of the movement as detected by the latest intraday move of the four major US stock indices that closed on a firmer footing. So overall, we continue to see outperformance by the Russell 2000 that is up 0.44%, and followed by the Dow Jones Industrial Average, which is up 0.17%. And both of them trade at a fresh all-time high yesterday, in line with the S&P 500, which is up by 0.16%. But the laggard continues to be right now the Nasdaq 100, which is almost traded almost unchanged at 0.08%. So very clearly, we now start to see a kind of a sector rotation play, which I did mention earlier in late December to look out for, where prior leadership role that has been undertaken by those mega cap technology stock centered on this AI optimism theme play that has the biggest component weightage in the Nasdaq 100. Now the Nasdaq 100 is now taking a backseat and allow the previous laggards. So the laggards are the industrial stocks, the financial stocks, and in some form consumer cyclicals, and as well as even healthcare and energy to take a leadership role right now, together with the small cap Russell 2000. So all these are being in play right now, in line with a potential Goldilocks economic, we call it growth situation in the US, where in the last few weeks, we start to see ISM services PMI remaining firm. And on top of that, last Friday, we do have a soft non-farm payroll data indicating that the Fed still needs to continue its interest rate cut cycle and also continue to purchase short-term treasury bills to end the quantitative tightening process that has been underway since December last year. So net overall, there's still liquidity pumping into the US financial system, which in line benefit the US stock market. But right now, the market participants are shifting their attention away from those much more highly valued, or put away that overvaluation risks in those mega cap technology stock centered on this AI optimism theme play, back into a much more lower valuation stocks or sector, which is the industrial, the Russell 2000, and as well as the we call it the various financial stocks, industrial stocks, and certain consumer cyclical, healthcare, and energy stocks over here. All right. So that is the story about the US stock market. And very quickly, let me flash for you the chart of the US stock market, the cash stock market. So this very clearly, we start to see a series of strong bullish candlestick that has taken shape on the Russell 2000. So this is the Russell 2000 index, fresh all-time high yesterday, closing high yesterday. Similar on the Dow Jones Industrial Average as well, managed to broke above the previous all-time high of last week, which is 6th of January. And marginally will be the S&P 500 also breaking above a fresh all-time high. And the one that is lagging behind is the Nasdaq 100. Yeah, but the good thing about Nasdaq 100 over here is that it continues to show resilient above the 50-day and the 20-day moving average despite lagging behind. So what I'm trying to actually express to you guys saying over here is that in terms of directional movement, potentially, all the four major indices are still in a bullish movement. It's only the rate of movement, which is the magnitude. So the Nasdaq 100 will have a lower magnitude or lower bullish momentum as compared to the Dow Jones, the Russell 2000, and even the S&P 500. All right. over here. So that's for the state of the US stock market. So let us now move to the state of the FX market. So what you could see over here is that in the FX market, let me share with you the US dollar chart first over here. So the US dollar chart continues to have a potential bearish reaction of the upper limit of this key intermediate resistance zone that we highlighted earlier last week at 99.22 and 98.86. So it has a bearish reaction of 99.23 over here. Yesterday's closing price, it closed below the 50-day moving average. And in today's Asia session, there is a slight rebound on the US dollar, up by 0.07%. So what is leading this rebound in the US dollar is this very persistent yen weakness, or the very persistent dollar strength against the Japanese yen. So what you could see over here is that it's very interestingly, there's no news, there's no actually a strong catalyst that's supporting this dollar strength against the yen. So despite the fact that we know that yesterday there was a meetup between Japanese Finance Minister Katayama and her US counterpart, which is the US Secretary Scott Bessent, has failed to stem the weakening of the yen that actually surged above the 158 figure level, and that's actually a 1 year low. That the dollar is at a 1 year high against the Japanese yen, or we call it the Japanese yen is at close to 18-month low against the dollar. So she did mention that she expressed my concern about the one-way weakening of the yen, as Katayama told reporters during a briefing following the meeting in Washington over here. And also the US side of the thing, Treasury Secretary Bessent also shared those concerns. So despite this kind of verbal intervention from Japan Finmin Minister, and as well potentially from Treasury Scott Bessent, we got to be pretty much cautious about this one-way movement of the dollar yen over here. So we know that now there's a K-shaped performance in the FX market, where the dollar continues to strengthen against the Japanese yen. But we got to be very cautious right now, as the authorities are watching this rapid movement of the dollar yen without any clear signs of fundamental catalysts that drive this dollar strength against the Japanese yen, where we start to see the dollar remains muted against other major currency pairs. So the dollar now is the weakest against the Swiss franc, which is down by negative 0.27% based on the 5-day rolling performance as of today. We are speaking right now, 13th of January 2026 at 11:17 a.m. Singapore time. And not far behind will be the dollar CNH, the dollar Chinese yuan, which is down by negative 0.13%, followed by the dollar euro, where the dollar is down against the euro by negative 0.06%. And the continued dollar weakness against the offshore Chinese yuan continues to drive a positive feedback loop into the China-related stock market, where the Hang Seng Index is up by 1.11%. And if you look at the CSI 300, it's almost trading unchanged right now. And the China A50 is up by 0.14%. And with this continuation of this dollar so-called weakness that is taking shape across other major currency, that also allows the Asia Pacific stock market to strengthen as well, where we start to see the Australia ASX 200 up by almost 1% at 0.96% as we're speaking right now. The Straits Times Index is up by 0.5%, inching to a fresh all-time high. So that being said, we are now still continues to see a kind of a general risk-on environment in global stock indices, driven by the fact of a much more broader-based weakening of the US dollar, and also driven by the fact that the US stock market continues to trade on a bullish tone. And the only outlier that we got to be mindful in the FX market right now, pardon me, will be the one-way rising movement of the dollar yen that actually are now being expressed by concern between two sides of the country, the Japan Finance Minister as well as the US Treasury Secretary as well, concerning about this rapid rise of the dollar yen in the last past week over here. So with that over here, now let us now turn our focus to the chart of the day. All right, the charts of the day. Well, there's a couple of charts I want to share with you guys. So let me expand my screen so that you guys could have a better view of the charts here. All right, so let us start with the FX market first over here. So over the FX market, I want to share with you will be the dollar yen over here. So definitely the dollar yen, what we could see over here, we see a strong squeeze up over here. So this squeeze up right now is coming very close to a medium term pivotal resistance that I define on the daily chart. So later I'll share with you why this is a medium-term pivotal resistance. Again, for those who know already understand why it's a medium-term pivotal resistance, 158.80. All right. So let me now jump very quickly to the daily time frame of the dollar yen. So this 158.80 over here is the former swing medium-term swing high of 10th of January that give rise to a medium-term 4-month of down move that's been seen on the dollar yen from 10th of January all the way down to 22nd of April, hitting a major range support level at the 140 level / 138.90. And this 158.80 also correspond previously with this bearish breakdown over here on the 11th of July and 12th of July, where it break down and it retested before shaping that close to this two months of down move to hit that range bottom again on the 16th of September 2024. And what causes this 2 month of down move after breaking below it on 12th of July is due to the 11th of July 2024 BOJ intervention, where at that point in time, the Ministry of Finance instructed BOJ to sell the dollar and buy back the yen at that point in time. So there is a real intervention. So right now, we are now coming back to this intervention level again. And also given the fact that what has transpired yesterday was this, we call it public remarks that is being made by both sides, which is the Japan FinMin and as well as the US Treasury Secretary, sounding concerned about the one-way rapid upward movement of the dollar yen. So what we could see over here is that the dollar yen right now is showing signs of hesitant. So there is this, let me expand it. There's this hourly potential shooting star candlestick that is being formed right now as we are speaking at 11:21 a.m. Singapore time. So indeed, market is now kind of reacting to this 158.80 medium-term pivotal resistance on the dollar yen. So for now, I will be looking at a potential neutrality stance first. So I will remain neutral between this 158.80 and 157.50 level range. All right. So only a bearish breakdown below 157.50 over here will potentially seek out a kind of a intraday corrective minor pullback to retest 157.28 followed by 157 figure level, and below it exposes the 20-day moving average at 156.30. So that's for the dollar yen. Okay, next up will be the Aussie dollar over here. So the Aussie dollar continues to trade in a very firm footing, still holding above our medium-term pivot, our short-term pivotal support level, pardon me, at 66.70 / 66.60 over here. So with that, I will still continue to watch this Aussie dollar as my chart of the day. Why I select Aussie dollar as my chart of the day is due to this general risk on behavior that is still persistent in the global stock market. And we know that the Aussie dollar is being used as a proxy of a risk on, very sensitive to risk on behavior. So if we start to see risk on behavior intact, it could support a firmer movement on the Aussie dollar against the USD. So the Aussie dollar continues to maintain a bullish buyer stance using 66.70, 66.60 as my short-term pivotal support level for now, given the fact that it hasn't broken above our intermediate resistance that we highlighted yesterday at 67.20. If we have a clear bullish breakout above 67.20 later during the European session or the London session with an hourly close above it, then I could tighten my pivotal support level to slightly higher to 66.90 over here. So the next resistance level to watch on the intraday basis will be 67.60, which was the 11th of October 2024 swing high that got retested on the 7th of January last week before it did that minor pullback. Only a bearish breakdown below 66.60 will invalidate the bullish buyer's stance on the Aussie dollar to see another round of minor corrective decline sequence unfolding, exposing 66.30, maximum 65.90, which confluence with the rising 50-day moving average. So that's for another chart of the day, which is the Aussie dollar. So let us now focus on the so-called the global stock indices, starting with the Nikkei 225 or the Japan 225. So the Japan 225, yesterday we do have a bullish bias with a very tight short-term pivotal support level at 53.37, with the intermediate resistance at 54,101, which is hit yesterday during the US session. And what's interesting over here is that the hourly RSI hit an extreme overbought level and flashed out a bearish divergence. So what it means that the very strong rally that is being seen on the 8th of January last week is now hitting a kind of a extreme intraday overstretch movement on the upside, and there could be a start of a minor corrective decline taking shape. So with that, I will have a intraday bearish bias for today for this potential minor corrective pullback to play out on the Japan 225, which represents the Nikkei 225. So using 54,110 / 54,185, that will be my short-term pivotal resistance for today. Potentially, there could be a minor corrective pullback play out with two near-term support level to watch out for: 53,370, which was yesterday pivotal support level. A breakdown below 53,370 may open up scope for a deeper minor corrective pullback towards 52,830, 52,644. So once price action level reach close to this 62,830, 52,830, 52,644, potentially there could be another round of bullish reversal coming back into play in order for the Japan 225 to resume its minor and medium-term uptrend phase impulsive up move sequence. So that's for the Japan 225. Next chart of the day, we in the global stock indices, our highlight will be the very strong traded bullish firmly US Wall Street 30, which represents the Dow Jones Industrial Average. So why I want to feature this chart of the day, because this week will be the release of key major banks, financial institutions, which I highlighted yesterday. Later I'll share with you, there will be a release of one of the key major US banks Q4 earnings result later today. And given the fact that we have a slew of key US financials earnings result that are going to be released this week, it will have a significant feedback loop into the US Wall Street 30. Why? Because the financial sector constitute close to 28% in this price weighted US, given the fact that the Goldman Sachs or top 5 component stock inside the Dow Jones Industrial Average. So for sure, it will create a more highly volatile movement on the US Wall Street CFD for this week. So that being said, the price action reacted positively yesterday in our first intermediate resistance zone, which is at the 4,925. And what's interesting over here, despite that it can't break out above this minor range resistance that has been in play since 7th of January last week, which is at 49,606 over here, but the hourly RSI has staged a pretty bullish breakout by breaking above this former descending trendline resistance, broke out it and retest it during the start of today's Asia session as we are speaking right now. So with this positive momentum that is being shown on the hourly RSI, I would be able to adjust the short-term pivotal support slightly upwards for today from 48,870 / 48,770 that I have yesterday to 49,250 / 49,096, which was the minor bullish reversal swing low that's being printed out at the start of yesterday's US session. So as long as this Titan adjusted 49,250 / 49,096 short-term pivotal support zone holds on the US Wall Street 30, I will still continue to maintain that bullish bias for today for it to seek out the next intermediate resistance at 49,805, 49,840, and above 49,840 will potentially see the next resistance coming in at 50,265, 50,335, which is a Fibo extension cluster level. All right, and if you will do a much more steepened parallel ascending channel linking the bullish reversal low of 2nd of January and the bullish reversal low of yesterday, that also constitute very closely to the upper limit, close to the upper limit of this much more, sorry, let me do it. Yeah, close to the upper limit of the much more shorter term steepened ascending channel that has now been evolving since the minor bullish reversal low of 2nd of January, and as well as the minor bullish reversal low that's been seen yesterday at the start of the US session. Only a bearish breakdown below 49,250/49,096 that would negate the bullish bias move to see a choppy minor corrective down move to retest this range support area at 48,870, 48,770, which is a former minor range top now that was previously in place since 12th of December and 26th of December, broken out and turns into a pullback support level, and that also corresponds with the rising 20-day moving average. Right, so that's for the US Wall Street 30, and that also sum up the second segment of the daily dose. Right, so now let me move on. The last segment will be touching you guys what are the key economic data to look out for today. Right, so today, Tuesday, so during the start of the London session or the European session over here, we do have one ECB official speaking. ECB's Poland speech will be at 4:15 p.m. Singapore time. So that could potentially influence the euro dollar, the euro crosses, and in some form the Germany 30 CFD index over here. And heading down towards it over here, give me a minute. I think this was okay. Sorry about it. Sorry about that. So this is not the correct calendar. My apologies, but I know why it hit the previous week. It should be showing this week. All right, my apologies. All right, so let me restart everything again to kickstart what will be the key data to look out for today, 13th of January, Tuesday over here during the start of the London session or the European session. So during the start of the European session will be rather quiet. So the action will come at 9:30 p.m. Singapore time, which will be the US inflation rate. So the US inflation rate will be the month of December. So what market expecting is looking in at the core inflation rate year on year over here. So for the core inflation rate year on year, that strip out energy prices and food prices, market is expecting a slight uptick to 2.7% year on year from the November print of 2.6%. So market is really expecting a kind of a elevated not elevated, kind of a persistence core inflation rate that going to hover around the 2.5% level to 2.7% level. So as long as it maintains within what market is expecting at 2.7%, I do not see the potential market expectation to erase the Fed interest rate cutbacks for this year, where market continues to assign at least 2 Fed cuts before 2026 end. So let's take a look at the latest CME Fed Watch 2. So based on the latest CME Fed Watch 2 over here, we know that for sure market is not looking for the Fed to cut in the upcoming 28th of Jan 2026 FOMC meeting, which is the end of this month. So market is still looking for a rather high odds. Give me a minute. Yeah, of 95% that the Fed will stamp at 3.5% to 3.75%. So if you look at the aggregated tab where we see it down the road, so after that so-called fiasco between that so-called latest Department of Justice criminal charge that's been brought against the current Fed chair, we now start to see the rate cutbacks continue to push down the calendar over here. So right now, market is expecting the next 4th cut to come in much later on the 17th of June, all right, at 95.98%. So very little chance for it to come in March and April, which is only at March will be 30%. April, about 50% chance, coin flip at 47%. So this April movement may change at 47% right now after the release of this core inflation rate data, where market participants expect a slight uptick. So if it comes in below expectation, like 2.6% or 2.5%, I could reckon that this rate cutbacks will start to increase for the 29th of April 2026 meeting, all right, to much higher than 47% right now. So all in all, if you look at the end of the year, by the end of the last meeting, 9th of December, pardon me, 2026, market participants, 91% is expecting the Fed funds rate to be at 3% to 3.25%. So what it means that overall market is still implying at least 2 interest rate cuts by the Fed. All right. So this is something to look out for at 9:30 p.m. Singapore time today that could influence almost all asset classes. Then thereafter, at 11:35 p.m. Singapore time, we have a Fed official speaking, Fed Musalam speech, and also heading into the early Wednesday session, 14th of Jan at 5 a.m. Singapore time, we have another Federal Reserve official speaking, Fed Bucket. And also one data or event I'm going to share with you guys will be the release of a major US bank earnings result today, right? Which is, let me share with you guys very quickly. Okay, JP Morgan. Right, so JP Morgan will release its Q4 earnings today. So market is expecting increase in earnings per share from the previous quarter last year at 4.81 to 4.94. All right, so that's a kind of a consensus will be still continuous affirming of their earnings per share trend. So JP Morgan will report its earnings result before the start of the US session. So do expect some volatility in the major US stock indices, especially the Dow Jones and as well as the S&P 500 before the start of the US session due to the earnings result of the earnings release of JP Morgan before the start of the US session today. All right, so with that, that ends today's Daily Dose of Market Insights. I'm Kelvin here signing off. I wish you all a great day ahead and we shall speak again tomorrow. Thank you.